Thanks, Sarfaraj. I think we've got to lift this up. Okay, I know you're all waiting for a break, so I'm going to take this as fast as possible. Can you guys hear me? Okay, much better. I have to hold this way. Uh, cool. Like that stuff. Okay, great. My name is Deepak Shenoy. This is the first time I've met Dharmaraj, and the first time I met a whole host of people over here. I tweet as at Deepak Shenoy on Twitter, and I write a blog called capitalmind.in. I have done a whole lot of things in the past, including running a software company and setting up an algorithmic trading outfit in Bombay. I was in Gurgaon till recently. I've come back. I'm actually currently consulting at a banking software company, but my love is markets. I don't trade quite as much now as I do because this consulting opportunity is full time, but I've been through the process and I've kind of found that there are certain things that just don't work with me, such as intraday trading, just not with me. But the love is Indian markets. The love is trading and understanding the financial business. So what I'm going to talk about today is largely about how data, it's a different session from the ones you you saw earlier, in the sense that I'm probably the only guy who's not going to tell you how to make money, okay? Because this is one session, I will warn you right up front, is probably the least directly related to a trading opportunity as possible. Any of the charts here, if you use a 3x5 EMA strategy, you will probably lose a lot of money. Because and you'll find out why I say that in a while. We're going to talk about what a macro picture means. When we're talking about macro, we're talking about data that seems to be not related, not relevant to the market, and suddenly it starts becoming relevant. And how, in different ways, does it impact markets? Specifics, wherever it comes to India, because you get a whole lot of news that's not related, like Brad Pitt marrying Jennifer Aniston does not have any impact on Indian markets, for instance. But if you have questions, just raise your hand. I'll take it as we go. But we probably want to leave it towards the end. I'm going to start with a small quiz. This was originally designed for the afternoon, when I was hoping that if people are sleepy, they can come out with a quiz and all that. This is the easiest question, so I probably am not going to. I'm going to ask it anyway. What happened on May 18, 2009? Why did the index close up 20%? Does anybody know? Okay. Everybody was shocked. I love that answer. Okay. Okay, we've got stable government as one answer. The surprise result, was it a surprise? I don't know. Okay. That was it. I think for the most part, that was kind of consensus answer. No left, we like it. Left was out. There was no left party in the government. That's a good point, actually. 2008 was a high, and then we saw that. But anyway, I guess the market needed a reason, and it got the reason, right? So next question. This is probably still something that people might remember. On October 17, 2007, there was an opening lower circuit. Market opened in the lower circuit. It's that little red arrow that's really down. It actually didn't close in the lower circuit. It recovered intraday very fast, but the market was closed. Does anybody remember why? Yes, okay. Yes, there was about some Damodaran, but anybody knows what he said? Yes, that was it. P notes. Damodaran made a statement saying that FIIs that come in using P notes will no longer be allowed. That was the indication people got, and I think it was said the previous evening at 4:30. That's why the markets opened down, and then a whole lot of clarifications were given, and then they said, okay, this is actually news. I had told you 4 years ago that I will ban such P notes. 5 years later, I'm just giving you one more year to comply. So the markets rallied back up. Third question, what happened? This is again something most people know. Low circuit in May 2004. Good answer. That's the BJP government lost, and everybody thought, that's the end of the story. And again, the left came in. This is probably less known. I didn't know it before I read the answer. Within 2 minutes of hearing the words regrettably, US stock markets fell, bond yields rose, and oil went up $3 per barrel, which was a huge amount at that time. Why? Okay, this word, that's the answer. This was said by US Secretary of State James Baker. This was after his meeting with Tariq Aziz, who was the Minister of Iraq. The idea was that they would come to a conclusion and this invasion of Kuwait will be, backed out. When he came out, the first word he said was regrettably, and nobody waited. The market just tanked immediately afterwards. Okay, so if you were a person completely ignorant of stock markets, you would say, why? There's a war, there's some RBI regulation, some elections. How should it, why does the market care? And apparently the market does care. And typically it doesn't seem to affect, it shouldn't affect markets because as we've seen, we succeed despite our politicians, not because of them, right? So why should politics affect our stock markets? But obviously sometimes it does, and quite dramatically. And what I define as macro, and not everybody defines it this way, is news that is not directly related to a stock or to an index or to a sector. That could be political or geopolitical. You've got even natural disasters. The Japanese earthquake and the subsequent fallout in Fukushima. There's a whole lot of consternation about what's going to happen, and of course stocks that were directly related. The people who manufactured nuclear plants or nuclear equipment like BHEL, they were impacted in India and abroad as well. But you had overall stock markets impacted too. So there's I classified as four broad ways that macro news impacts markets. Okay, so you got a perception issue. There's no left party in the government, so everything will be a good thing. The markets go up. There's a fear, so if there's no P notes, FIs will not come. Although everybody understands at that time, everybody understood that P notes was a way to launder black money. But all this Kejriwal stuff is all great for TV, but if you really ban black money, stock markets will fall. At least that's the lesson I got, okay, out of the whole thing. You can't ban black money because, they keep our stock markets alive. And that's the fear, and maybe it's irrational, maybe it's whatever, but that's the fear that stock markets seem to have. There's another thing of prediction, that people use news to predict a macro news. A war in the Middle East will raise oil prices. And that's a bad thing for stocks, good for oil, bad for stocks. And lastly, there are, these panic level layers of stupidity that happen. And all the time you get, so for instance, I think in the Euro, there was a huge rally one day when a small country had a referendum on whether it wanted to stay in the Euro. It was a tiny country, it had the Euro as a country, I forget who it was. But it was almost illogical for them to want to leave the Euro at the time. But but the minute that decision came, that their referendum had said okay, the US and European stock markets rallied a lot. I'm like, what difference does it make? But stupidity is part of macro reactions, if you may. Well, Indian markets, specific to a lot of stuff that we get data for. We get economic data from various sources. I'm going to just give a certain set of examples, talk about in some detail. You get GDP growth data every 3 months. May, May, and then August and November and so on. You get GDP growth data for the previous quarter. Typically, because it's released during market hours, markets tend to react to it. Sometimes even IMF releases estimates and markets react to that also. IMF will tell you that we estimate 4.95% Indian GDP growth. Markets fall. And they'll fall a lot intraday sometimes. I think this time it fell 2% intraday from its peak to bottom. But IMF has never been right in its estimate, okay? But nobody cares. Nobody cares that IMF has not been right in its estimate in the past ever, but things like this happen. Plus, what happens is data is revised like crazy. So what might appear today as a 7% growth, 1 year later will be revised to a 5% growth. Today's data itself. So what happens is, in 2013, if I revise 2012 data, the market doesn't care so much, right? But they always care about what's called the headline number. What is the number that you're revealing? Are you saying 6%? Are you saying 7%? Forget what you revised in the past. So, GDP growth is one data. Sorry. Yeah, Jan they did. Actually, in Jan they did something strange. I don't know if it was IAP or WPI. Previous data was revised and also new data. So previous data of the entire year was revised. Export data was right. It was not. Yeah, the current month was positive, and they revised the previous month to be positive. And also the export data was revised in one case where they said we had forgot the entire software was wrong, so they had recorded a lot of exports. So our exports is down by half or something like that. Some crazy number, and then we ended up with the market tanking, saying what's happening, or market going up in the IIP case. Data is revised like crazy. Like for instance, 4 times this year, inflation has been coming at less than 7%, first released. Okay, 4 times this year. When it has been released now, no month in the year is less than 7%. So every time it has gone less than 7%, RBI comes out with a statement saying, I think we are controlling inflation because it is less than 7%. But when it is revised back to above 7%, nobody comes from the RBI and says, boss, we were wrong. Okay, so but that's a different aspect of the whole thing. The idea is, what data is this, and the immediate impact of the market on the market is quite visible sometimes. Inflation, which used to come out weekly, now comes out only once a month. There's a wholesale price in WPI, which is more important in Indian context. It is what is used to calculate real GDP growth and economic growth, wage growth. Central government, I think DA is based on WPI, or I don't know which some large number is based on the WPI. The CPI is a fairly new indicator. It comes in on the 12th of every month, 12th or 15th, of every month. There are other pieces of data that come in. There's something called a purchasing managers index. This is calculated by HSBC and market. Comes out in the 1st and the 3rd of every month approximately. IAP, industrial production, we know this is a notoriously bad indicator. Our current account deficits and fiscal deficit situations are revealed usually monthly. Liquidity, bank liquidity in the liquidity in the money markets, and the liquidity situation is revealed by RBI every week, and actually if in certain cases every day. This is not something that as traders we'd like to track, but they're useful to see in a long-term trend. As in, and because these things don't change overnight, they don't like fall 10%, rise 10% every day. They are trends. They're very slow-moving trends. So if you see something pointed upwards, it takes a long time. I mean, if you start seeing it point downwards, it's usually a macroeconomic change that's happening. Um, Credit growth is another thing. We are currently at levels last seen in 2009 on credit growth. The amount of credit banks give the corporate and the private sector is slowing. And you can see the trend dipping downwards since I think 2010. And we are at levels last seen pretty much at crisis times. I'll come to all the graphs there. There's money supply also. This is also revealed every fortnight. The idea is, what data points do you get at various points in the market. Okay, let me give a broad status of what money supply is and what liquidity is. How many rupees in notes do you think the RBI has? I'll give you a number. Okay. 13 lakh crores is the total amount of rupee notes in 100 rupee notes or 500 rupee notes or 1000 rupee notes that has ever been printed by RBI since its inception. Total. I don't know about Pakistan, honestly. They must have printed a few of our notes as well. But the total number of these notes in the system are 14 lakh crores. But if you add the total amount of money in all the bank accounts of everybody in the country, what number do you think will come up? Any ideas? 15 lakh crores, 12 lakh crores, 20 lakh crores? So it's 76 lakh crores. Okay, so effectively banks invent money to a certain extent because it's very straightforward. Okay, I'll give you 100 rupees. I'm a bank. You don't keep the 100 rupees. You say, I'll give it back to you, boss. You keep it in your bank as in my savings account. I'll say, fine. Then I'll go and give him 100 rupees and say, I'll give it to you as a loan at some interest. Right? He'll take the 100 rupees and put it back in the bank because he says, I don't want to keep the money. So every piece of money you keep back in the banking system. And now you have 100 rupees. You think you have 100 rupees. He thinks he has 100 rupees, but I only had 100 rupees to start with. I can keep doing this for as much as I want, but RBI has some regulations of some, cash reserve ratios and some other ratios that it uses to control this leverage. So it knows how much it has printed, what money it has in what is called reserve. That's the reserve money. It knows how much money is all the bank account bank system added up. So it knows the difference. If it is 1:5, it's fine. If it's 1:20, it's bad. Europe is 1:30, okay? Sometimes. Some banks are at 1:30, which is crazy, but that's the way it is. So because banks create this money, the idea of money supply comes in. It's like there is something called reserve money. Reserve money is you can think of it as money that originated from the RBI in a certain way, or is base reserve of this country. That's about 13 to 14 lakh crores. 76 lakh crores is what is called broad money supply. So that's the total amount of money in the banks. In the past, if you look at money supply growth, every year the money supply grows by a certain amount. Now, to do a short macro or economic lesson, let's say we were only 100 people in this room, all right? And one of us, there was only one bank, and one of us took a loan of, say, 100 rupees. There was only 100 rupees available in the entire system. The 100 rupees was used to create 100 widgets. I'm going to sell them at 1 rupee each. Okay? But the same person, once he takes the loan, sorry, he can now produce 150 widgets. Right? But there's only 100 rupees. I've only printed 100 rupees. So how much does each widget go for? 67 paisa, because I won't pay more than 67 paisa if 150 widgets has to be divided by 100 rupees only. So I have seen the price of one widget drop from 1 rupee to 67 paisa. This is typically easy to do when you buy rice. You don't mind its price going down. But when it comes to your salary, you don't want to see it go down. Your salary is a product in the economic marketplace, right? People don't like their salaries to go down. So what I'll do is I'll print another 50 rupees. Because we've had 50 rupees more of productivity. So I'll print another 50 rupees to balance it out, and I'll say prices have remained the same. Okay, so this is how money supply by the RBI keeps increasing. And by the other example I gave you, where banks lend, take the money back, lend again, they multiply the money supply. So I have reserve money supply growth, which is typically whatever, which should be typically what your new levels of productivity are coming into the system. Unfortunately, the RBI has been printing like crazy in the last 7 years. They have been increasing money supply by an average of 22% in the last 7 years per year. That means if there were 100 rupees in the system, it was 122 the next year and 150 something the next year and so on. So, now that is what definitely causes inflation. Money supply growth causes inflation. In Germany in 1922, there was hyperinflation. The government was printing 50% of its money supply every single day. Prices were going up 150% a day. That means what you bought, every workers were paid salaries twice, mornings and evenings. And every time you got money, you would go straight to the markets and buy whatever the hell you found. Well, it doesn't matter, cash was worthless. It was getting printed by the buckets, literally. So, if you look at it that way, money supply growth, endless money supply growth is a bad thing for inflation. But you need some money supply growth. And if you look at it from an economic principle, when money supply growth starts slowing, you could have what is called a liquidity problem. A liquidity problem is not enough money in the market. Let me give you an example of a liquidity problem. All of you are depositors in some banks, you have savings banks account. Let's say you went to the banks and said, give me all my money in cash. Can the bank service that? The problem is, they've given that money out as a loan. And somebody's bought a car with it. They can't tell the guy, boss, I don't care, sell your car, give me back the money. Even if he does, the car price he will get is half of what he had borrowed. He won't be able to give the bank enough. The bank won't be able to give it to you. So the problem of liquidity is when a bank doesn't have enough money or the financial system doesn't have enough money to service needs. And typically this comes because let's say there are some large scale guy has defaulted on his obligations. In 2008 there was a rumor that ICICI Bank didn't have enough money. People in Baroda started queuing up in ATMs until RBI had to get into the act and said, boss, I will. Till date, RBI has refused to reveal what it did. To the extent of going to Supreme Court and defending its stance, saying, if I tell you what I did, it's a problem for the banking system. I'm like, boss, if it's so secretive, I really need to know. Okay, but it's that much of a problem. Liquidity is that serious a problem to the economy. And we all know what happened to the ICICI Bank share, okay? Just the rumor at that time and the fear that the market was this thing. Stock was at 200 and odd rupees or 300 rupees at that time. I don't know if you can see this. Let me just move on to this slide. Okay, there are 5 blocks here. Each of them has, I want to bring it back from broad economics to what is called market macro data. When you look at a market, in a traditional view of a stock market, it's a bunch of stocks. You either should get news that impacts a stock or the sector that it's in, right? But because we have markets, we have an index and we have sectoral indexes and all of that stuff, we've created various layers on top of an index or a market that give us an idea of what the market should be. An index VIX is a volatility index. It tells you what people are paying in terms of option premiums in order to buy or sell into the index. The idea is that this VIX number is usually an annualized percentage, estimated volatility over the year. So in 2008, where the VIX would have been so high as nearly 40, today it's probably languishing around 17 or 18. The higher the VIX is, the higher the option premiums trade, and higher people expect the index to be volatile. Today, if the index moves 100 points in a day, it's considered, my God, this is a great thing, you know. Like, I was actually quite surprised to see a 62-point move today. And I was thinking to myself, yeah, 5 years earlier, I would not have thought a 62-point move is such a big deal. Because it's happening every second day. Today, you know, 62-point moves are a surprising thing. So the index VIX actually gives you an idea of where volatility is expected to be. I won't say where it is. A question is, what's the average VIX for the last 1 year? Actually, I don't have that data, but you can get it. The NSE has a VIX indicator, and you can download the data and get it. No, the VIX, how does VIX impact option premiums? It's not that way, it's usually the other way. Option premiums determine VIX. So it's basically the quote, what you do is you calculate what is called an implied volatility of every option of the Nifty. I think they take 3 strikes in the money, 3 strikes out of the money, and on each side, calls and puts, and calculate the implied volatility at the bid and the ask, and average that out. That's the volatility index. Okay, hello? Will the VIX affect the index? No. It doesn't really impact the index. At least I haven't seen there is no direct impact. So let me go to market-wide indicators. You know, we all use a lot of market-wide indicators. For instance, put-call ratio. We use it's a market-wide indicator, and I have tried a lot of stuff with put-call indicators. Okay, with algo back testing, this, that. I have not found anything that works. But I know people would say they trade it, so you know it must be working for somebody. But it's a market-wide indicator. It doesn't have an impact on the market. We try to find a correlation. Is if it's high, will the market fall the next day, or has it already fallen, or does it imply that the market may fall in the next week, or something like that. The other set of market indicators we use, for instance, Nifty volumes. The volumes, there is no such thing as the Nifty that is traded, right? Only Nifty futures are traded. The Nifty is actually an amalgamation of all its stocks. And the volumes on the Nifty are again a synthetically built volume number. So if you look at Nifty volumes per se, it is not a volume that somebody has actually bought or sold. It's synthetically determined from the stocks underlying the Nifty. However, you can find trends in these volumes. And you use them. So those are other macro kind of indicators that you can use. The OI, the total open interest, is an interesting indicator, both from the Nifty futures perspective and individual stock futures perspective. For instance, individual stock futures have direct impact. You have something called a market-wide position limit. If your OI comes close, you know there's a potential trade that's coming up. For a market-wide OI, you want to see towards expiry where the OI is flowing. Right, and you've got the typical CNBC strategy of saying that if the OI is going down and the price is going up, then you're having, they have that funda of short covering versus, I don't know how they figure out with short covering or real buying, but I think they use this OI funda to calculate. I'm fine with it. I mean, it's a news channel, yeah. What difference does it make? But it's so you know, if the price is going up, but the open interest is falling, it's most likely to be short covering. There's probably reason to say that, but historically, it's very difficult to determine the difference between real buying and short covering. If you from a market, from just the open interest indicator, it's better to sit at a institutional broker's place and see what they're talking on the phone. That's more likely to give you whether it's short covering or buying. The other things that come in from why have I got exports and imports here? So you got market liquidity, which is money. So this is interesting because you know there were 2 crashes. I mentioned 4 or 5 big crashes. There were 2 crashes. That one that came in January 2008. One that came in 2006. I don't know if you remember. Before the 2006 crash, May, index fell 30% over 2 months. There was a big IPO the Reliance Petroleum RPL IPO. Now, going back in history, you look at that time and you say there's no event that really happened that should have caused that crash. But it turns out most people, a lot of people had put money into that IPO. And because the money was stuck for 15 days, you didn't really have enough money left to buy more in the market. So you automatically had a liquidity based move. What happened in Jan 2008? Of course, it might have been a lot of factors, the fact that it had run up and all that. But events that happened, there was a 5,000 crore IPO of I think Future Capital and a 10,000 crore IPO of Reliance Power just before the Jan 21st crash. And liquidity could have been one of the reasons why the market moved downwards, and there was no real support. If your money is locked, what do? There is other things that impact. I mean, FII flows, we look at it all the time. We say FIIs are buying or selling. We look at the FII futures buys and sells, which is fine. But we also look sometimes at FII options. They don't tell you whether they bought call options or put options. Huh? They just tell you they bought options. So that's the other thing that we look at on a basis. So you got to look at these indicators at different levels. I have used them in various layers of kind of supplementary or they're not my first say indicator to buy or sell, but I might use them to augment anything else that come in, a signal that comes in that says, well, that signal coincides with something else, which is like I have positive liquidity flows, I have great market-wide indicators, that's when I might want to get into a trade. Unfortunately, this data has a huge lag, most of it, other than the market macro piece, which even then I don't trust so much. Inflation figures come out a month later, and then they're lagged because they revised 3 months later. So you don't really see what's happening with inflation, really happening with inflation for a while. But typically the idea is you react to the number. I expect 7%, I got 7.5%, so it's a bad thing. So, but the real data actually appears much after it happens. The US recession of 2008-09, I think they found out only in 2010 that the recession had started in 2008. Okay, so it's not like you can look back and say, oh, there was a recession in 2008. I would have sold as soon as the recession started, boss. You won't know. You just don't know when a recession starts. And the other thing is that the reaction to the news that a recession happened in the past will happen now. Okay, somebody comes and tells you, my export data last year was all wrong. We'll actually react now, instead of thinking about the fact that something else should have added up. Usually, but one time, like an election result or a war announcement, these are exceptions where a macro data comes out, news comes out from the blue, and you can't, and it's a fairly significant piece. How much time do I have? Okay, I have some time. S&P downgrade, yeah, that's quite funny actually, because nobody knows what it means for us, okay? We don't sell, Indian government doesn't sell much of dollar denominated debt, which is rated. So you would be scared if, I'm the Indian government, you are a foreign fellow, I want to sell you my bonds, which I will buy, I will ask from you so many dollars, and tomorrow I will give back so many dollars, right? That is dollar denominated debt. India has, for the most part, rupee denominated debt. FIIs bid, they pay money to be allowed to buy India's rupee denominated debt, even today, even after the S&P downgrade. So the S&P downgrade should not affect us anywhere. But every time the news comes in that some fellow is going to downgrade us, the TV channels you should buy, because they'll talk for it for about 5 years, okay, after that. Not necessarily. ICICI was once rated at a higher level than the government of India. So it is not necessary that the country's rating is better, a company's rating is lower than the sovereign rating. So it is true that that SBI's rating is usually subpar the Indian sovereign rating, but I know that ICICI rating has been better. So it's not necessary that our companies are rated lesser than Indian sovereign ratings. It does, of course, raise the, because you see, it's like this. If I am a buyer, I will choose any reason to get bonds at a cheaper price, right? So if your country just got downgraded, I'm going to say that your country just got downgraded, boss, give me a discount. So that's how the markets will work. But it's not necessary. It's like we were just talking about this outside, about how software companies, you should actually benefit from the dollar going from 45 to 55. Except their customers are also seeing the dollar go from 45 to 55 and think, boss, it's 10%, it's gone up 20%, you give me at least 15% discount on the rates. So that software company that has set up a nice hedge, is screwed. Because it has to give a discount to be in competition, and it has this hedge that it has to pay. But anyway, that's a different aspect. But there is a different impact to different kinds of stocks of the same macro data. So, for instance, if RBI raises rates, you'll hit the banks first because it affects their cost of capital. You'll hit the auto and interest rate sensitive sectors next. This might actually impact the rate on the dollar, directly or indirectly. If the dollar depreciates or appreciates substantially, it affects exporters. So there probably exporters are not even people who borrow from the bank and care about bank rates, but effectively they have gotten impacted. And the other way, if a Greece exits the euro, people talk about why does it affect India at all? Well, it's likely there are people who export to Europe and you don't know. India's largest exports are to Europe. We talk about the US, we talk about this thing. Europe and I think China is one of are the biggest trading partners. A lot of Indian corporates have taken loans from banks in the Eurozone. They've taken dollar denominated loans, but they're from banks in the Eurozone. So the exposure, this will never be visible until something happens to the euro. Then you will get those Excel sheets where how much exposure each one has will be calculated, because all this stuff gets visible only afterwards. If exporters to Europe get impacted and then nobody else gets impacted, that's also fine. But soon global markets get impacted. There is a liquidity problem. There's no money in the market, and therefore it affects everybody else. So the problem is, I can always make doomsday scenarios, right? I can make 100 of them right now. I can say tomorrow the world will end because SM Krishna just resigned. And his resignation will create a flurry of other resignations and the whole government will fall and etc. etc. So you could go in various ways. So you don't know what macro news when it first hits you is going to actually be a deep enough hit. That's why it's like a train wreck in slow motion. You can watch news, more news, bad news, and the market will go down, a little more down, little more down. It can keep happening in front of you and you won't think it's a big thing. Except 5 years later, you look back and say, that was a really bad time. So, the other problem is if you're a trader, macro data reliance can be very painful. There's a guy called Michael Burry. Who's heard of Michael Burry? Okay, he was a hedge fund manager, came out of the blue, profiled in a book called The Big Short by Michael Lewis. This guy ran a hedge fund that shorted subprime securities. His idea was that people who were not able to pay back their loans were taking larger and larger housing loans, largely depending on the fact that prices of homes never go up, never go down. Like they never go down in India, right? Okay. So, so far, that's a, I'm just kidding. But, the prices would never go down because, even a software at a large, I think Morgan Stanley it was, the software installed for checking housing price risk didn't allow a negative figure in the box and, labeled change in price. They never thought the prices would go negative. Except Burry said, this is unsustainable and I'm going to short it. He started from 2005 or 2004. Started shorting subprime securities. He waited 2 or 3 years, lost money, got a lot of investors really, really angry with him because he was losing money when the housing market was going up. After that, I think he made over $2.5 billion, which is a lot of money. I mean, it's at least one house that Ambani built. But it, the idea is it can be really painful. Can you imagine 2 years, 730 days, losing days before you start seeing a profit? Looking at a macro data perspective, saying housing prices will come down, making a big trade. I'm talking about, at least I think he bet some $600 million or some crazy amount like that on it, borrowed this money from investors, held on for 2 years, made losses, and then suddenly came out with this massive win. He returned all the money to the investors. He's not managing other people's money since. Soros in 1990s, he held a massive trade against the British pound, largely on the fact that there was some macro news and he thought that the British pound is going to devalue. To the extent where the British secretary and their finance minister equivalent came on TV and said, I will support the euro to whatever, to the pound, to whatever extent possible. Soros doubled his trade. He actually broke it because in the end they had to devalue. The fundamental factors were too strong. But can you imagine, he was losing, he would have lost 8 times his capital if the trade had continued for much more. He would have been wiped out completely. A lot of traders do get wiped out. There's a guy called Victor Niederhofer. He's been wiped out many times. Trading stuff that he understands. He probably understands very well. But there's one event that just wipes him out every time. There's a company called Long Term Capital. Their funda was very straightforward. There's a bond which is 19 years to maturity. There's a bond which is 20 years to maturity. They're trading at different prices. They should trade at nearly the same price, effectively. I'm just going to buy one, sell the other, and make a profit in the middle. I'm going to leverage this strategy 100 times. So if I make a 1% profit, it will become a 100% profit. Simple strategy, except somewhere in the middle, some fellow in the Russian ministry decided that I'm not going to pay back my loans. They had levered so much that they ended up losing everything. To the extent that even while they were down, they were going to bring down the US financial system. They still said that these positions, if we hold them till maturity, we will make the profit. But in the middle, it's like saying, if there was a 5-year future, I bought it in 2008 at 6,000, okay, and I held it till today. I would have lost only 300 points, no? That's okay. But the problem is it went to 2,800. Somebody had to pay that margin. That somebody is me. If I am leveraged 100 times, I'm dead. So that's what happened. It can be quite painful when you use a macro data to make an assumption on a trade and just stick with it. Another company called Amaranth, though that's not really a macro data. They used to trade natural gas. They just took a very big bet on natural gas. There was a guy on the other side called John Arnold, who was an Enron trader. I think he made over 200% per year in the first 8 years of 2000, from 2000 to 2008. He just bet against Amaranth and brought down a $4 billion hedge fund by simply taking the trade against. The best thing was Amaranth was right. Prices fell after Amaranth went down. So, okay, I want to just take us to a few examples of what kind of macro data I look at. So, I look at index comparisons because I just want to see how our stocks perform. This is slightly old, about a month and a half old, 2 months old now. Comparison of where the Nifty is. If you look at, this is the 2012 comparison. If you look at 2000 till now, the Nifty is like, I think, second after China. It's fantastic. We are way ahead of any of the other stock indexes. So if you want to see overvalued, you want to see that chart. We've got inflation. I've got WPI and CPI, and we've got. This is how this is for me, it's just a macro indicator, totally useless for trading, but it's great to look at trends. This is our VIX. Unfortunately, here's your, I could probably give you an average VIX, but I don't have a number right now. Unfortunately, this is also a year old. I wasn't able to generate the latest chart. I generate these on Excel, largely just download data and see where the market is. I use this as I read a blog post and somehow it sounded quite interesting, so I thought I'll plot it for the Indian market. The number of, what is a trend day is simply a stock that opens in a certain direction, below the previous close or above the previous close, and goes in the same direction and spreads at least 1.75% away from the previous day's close. So that's a trend day. It opens in one direction and closes further down in that direction, and the open to close difference should be at least 1.75%. The number of trend days and in terms of number of points is kind of given here. It's not very accurate. It's not very useful because just points doesn't make a difference. The level of the Nifty also makes a difference, right? Because a 100-point move when the Nifty is at 6,000 is different from a 100-point move when the Nifty is at 2,800. So I haven't used that, factored that into the equation. But you can see 2008 where the trend days are widened, and 2008 has seen both 6,000 and 2,800 at the same time. Those were incredible days. This is liquidity equation. You kind of see where the government auctions T-bills every week. And I plot the yields, and I plotted them from 1998 to see where trends are. As you can see, this is a very nicely trending chart. Okay, it goes in one direction and it kind of stays in that direction for a while. So you want to see a turn, you're going to probably have to wait a little bit, maybe 3 or 4 months before you actually see the turn happen. So I use this to generally track where we are. We aren't really dipping in any meaningful sense of the word today. This is something I actually use for trading. It's the number of stocks that are above their short-term. Oh, I'm sorry. Yeah, there. Okay. What are treasury bills? So the government borrows from the market every day. I said the government does rupee denominated. The government borrows in 2 ways. It can take long-term loans as a bond. It sells bonds. And those are 5 years late, mature 5 years later, mature 10 years later, mature 15 years later, up to mature 30 years later sometimes. Those are called G-Secs or bonds or gilts. But government also issues short-term securities. So they say 91 days. You give me 99 rupees today, I'll give you 100 rupees after 91 days. The effective 1 rupee I give you is an interest, right? And that 1 rupee, because it's in 91 days, if I translate to 365 days, I would have got 4 rupees in 365 days. So it's a 4% yield on a T-bill, effectively. The government auctions about 13,000 crores worth of T-bills every week. There's 91-day T-bills, 181-day T-bills, 182-day T-bills, and 364-day T-bills. You might ask, why not 365? Capital gains comes in. If I get interest within a year, it is counted as my income, correct? If I get income after 1 year or more, if I held a bond for more than 1 year, it becomes a capital gain that's taxed at a lower rate. The government says, boss, I'll give you 8%, but you give me back 2% as tax. Okay? So that's what they want. I mean, they want to charge tax on it. So 364, and this is a worldwide mechanism, it's not just India. So everybody does T-bills at these levels. So that was T-bill yields. Stocks about DMS, I use this because I think this is a cyclical. The number of stocks above 20-day moving average, number of stocks below a 20-day moving average in the Nifty. The number above, I subtract from it the number below. So that will oscillate between plus 50 and minus 50. Because I can either have 50 stocks above the moving average or 50 stocks below the moving average. So you can see here it nicely oscillates between the red line is the one that oscillates between very high and very low. I like to take trades at the edges when I see a turn from there. So it's a little bit like relative strength, except it uses a broader market. And I have got these indicators on the Nifty and on a set of about 180 stocks, basically all stocks that have futures on it, which I assume has liquidity. So this gives me an idea of where the market's moving or likely to move. It's a useful option strategy, but I found that backtesting has given me much better results on futures. Now I'm not talking about that strategy here because, as I said, this session is not going to help you make money, I hope. Well, sorry? I post it on my blog every month or so. How do I get it? Generate it? Oh, actually, that's one interesting question. How do you generate this chart? I have written a software program to download prices, and I have, on top of that, I have these indicators which are actually calculated and stored. I export them to Excel files. So I have a software program that I've written to, take the numbers and crunch them and find out how many stocks are above and how many stocks are below. Unfortunately, that program is really, it's like a command line thing, so I don't know if it's something that I can share because it expects a whole infrastructure around it, a database and all that stuff. But there's nothing secret about this. I say this is what I do, this is what I trade. I have no problem in saying I trade it because, even if I explain the mechanism, I don't think it's an easy system to trade. Basically you can lose money enough times as well. So I post this chart on my blog every month or so, approximately. No, I have not tested it for option trading. I sometimes stupidly take options positions, thinking that this is what will. If I got so good results using futures, I should get even better results using options. That's not the case. Last month I lost about 70% of my option premium because I took an option position instead of a future position. In the future position, it's still short, but I would have lost only about 25-30 points. Because I lost my time value. This system doesn't tell me when the downturn will come. It just tells me that it's at the edge, so it's likely to go down. So these are some random charts that I look at, as a macro factor. You look at steel. I was analyzing Tata Steel at one point. So people tell you there's overcapacity in China. You have no idea how much overcapacity is there in China. The left bar is Chinese steel production, okay, in 2010. The next 10 countries, including India, are on the right. If there is a slowdown in China, where will all that steel go? Okay, that is a question we have to answer if you are long Tata Steel. So I look at also Nifty, including dividends, because that's a more reasonable factor to look at. Also, I haven't calculated in here, but I also look at the Nifty, the dollar defty as a source of return to see where stocks are, but that's less useful to me. I trade in rupees, I don't have any dollars. So the rolling returns, including dividends, over a 10-year period. This is again up to only about July this year. I haven't updated the chart since then. You can see that the 1-year return is low. It hasn't been updated for the change figures, but a 10-year return is still fairly good. It's still 18% rolling, and that means people have been the children of this boom. The boom since 2000 or 2002 or something like that, have had a great time if they've been in stocks. Yeah, 2007-8 was bad and stuff like that. But if you've been around in the market for about 10 years, you don't think the stock market should return 15% every year. That's the thinking. But you ask me what happens to 10 years before that, and then things change because the years 1993, 94 approximately to 2000 were very, very substandard in terms of annual returns, less than 6%, I think. This is something I know, I mean, this is a very well argued thing. I look at past PE, price to earnings ratios, and the growth. So, you know, in my mind, I'm a very simplistic guy, okay, when it comes to this. If your EPS growth, I'm earnings growth of 16%, I'll get a P of about 16. If I grow my earnings 20%, I should get about 20, you know, on an average. There's no real, you know, it's just the thumb rule. So my deal is as a Nifty as a whole, where has earnings growth been today? And where was my P last year? Because my P is supposed to be forward looking, right? So where was my P last year? Have they ever met? The answer is yes, they met once in the last 4 years. And earnings growth was very heavy in the 2007-2006 time frame. But that time is gone. Earnings per growth is currently at about 9% a year. Sorry. So EPS, if the EPS is 0, what's the P ratio? The answer is infinity, effectively. But Nifty has a P. The Nifty's P is the sum of the earnings of all its constituent stocks, right? Effectively. If there are some stocks which have to, no, I don't do this. This is not this is a macro data. It's not about individual stocks. So individual stock P is different. So I don't know how you value a company that doesn't have any earnings. So I'll trade those stocks using technicals. It's much easier, right? Because if they don't have any earnings, you can only project based on what you think. So Reliance Petroleum was a great stock until its refinery came up. You had no idea what that refinery could do, what the price of oil would be when the refinery came up, whether there would be any demand for oil at that level. Nobody knew, just knew that he was building a big refinery. So when you didn't have earnings, you just make projections and value a stock. But this is macro data. So the PE of an index as a whole is different from how you analyze stocks. There are, this is my last slide, known issues. There's always going to be bad data. You will get some data that somebody says gets revised all the time. There's also interference. You know, you might think, you know, something bad will happen, and you bet on that something bad happening. Except some government intervenes and gives bailout. Okay, you might go short some stocks because you think fundamentally they can't survive. This is a bad time for them, and suddenly the government comes in and says bailout, I will fund you. Stocks go back up. Sorry. Or there's something called quantitative easing, which is an effective bailout of the banks, of the banking system. I won't go into detail of how that happened, but that's very likely. There's also the fact that you have a lot of black swans. So you might look at a great graph. Okay, it looks like this: money supply growth, 15, 16%. One fine day, 10 Kingfishers type companies default. You find suddenly money supply falls by 8%. It's never happened. You can look at all the past data in India multiplied by 5, you'll never see minus 8%. One day that could happen and you wouldn't have expected it. Also, this is in trading in general. We underestimate the impact of luck on our trading. Okay, we are tremendously lucky. I am, at least. I was born a long time back. But I graduated in 1996 when all software companies were hiring like crazy. So if you could spell computer, you got hired. Okay, I walked into the software industry. I saw the greatest software boom ever in the first 4 years of my career. And then I saw a bus, but then, you know, if you're already up in the system, India didn't see so much of an impact. So boom, I carried through. A lot of my peers, then in India saw the greatest economic growth that it has ever seen in the next decade. I'm tremendously lucky. My dad never got to see all of this. He struggled through some emergency and some random other stuff. And yeah. So if he did something, it was probably more of skill than me. So I'm lucky in life, and I think I'm lucky in trading a lot of times. It's just pure luck because I can't explain it. it, so we we look at these macro things, you sometimes think that you become very intelligent. When you take a trade and say, boss, it became right. I did all this macro analysis. I bought this chart, one MA, and I put my P data, IIP data, and I said it's going down, it went down. But you were just lucky sometimes, okay? I was just lucky, I know that. And I think we under-attribute it, so if you do too much analysis also, you can end up with this feeling of arrogance. But I would not recommend it. Sometimes, take a notch down, lose a little money. So I'll throw this open. Am I have time or? Okay, 19.
Deepak, last year I remember you were short on Bank Nifty, I think in November 2011 or December 2011. You were highly shorted in the Bank Nifty. I remember the profits you made, you went on a vacation. So, all through this session you have been telling us this is not a session where you will tell us how to earn money. That's what all of us here are for. So tell us what made you take that trade.
That's a good point. I didn't come into this session thinking I'll help you on how to make money, because this is all these random charts, right? Which you can always ask me, boss, how do you look at these charts and make money? And I don't have a real answer. I'll give you the answer to this question. I was short the banks because of two factors. I think there was a technical factor on it, where it was not just banks, everything else had broken down. Last year, I think there was when the first time it went to below 5,000, and then it went down. But the other fact was I was looking at, there were 3 or 4 macro figures. There was the dollar that was crashing. And there was this whole Euro-Greek bailout, and I said, okay, forget the fact that it does happen or not. The entities that it tends to hit the most are banks. So it was not really a technical or a system trade, but there were a confluence of multiple factors that kind of pointed to me to say the banks are. And to be honest, here's the deal. I would have actually gone short the Nifty, but the bank Nifty had a much better, the number of stocks above the DMAs, although it has much lesser stocks, it was much more at a better position to short than the Nifty. So it ended up, it ended up making me some money, and I blew it up on a holiday, which is a bad thing, because I forgot that afterwards the next trade might actually lose money. So I have to recover my holiday sometime. So, but still, it's good. It's good to see a trade come out right. And I don't remember the exact circumstances of why I took in that trade, but I have it in a trade log. So I'll get back to you on that. Can I take that?
Yeah.
Does it work?
Yeah, you said that RBI is increasing the money supply by 20%, 22% per year. So is this case in 2011 or 2012 as well?
The money supply in the last 1 year. Now, if you look at narrow money supply,
Okay.
which is the money that RBI prints, reserve money, that's growth has come down to something like 7% now.
Okay.
One of the reasons is that the cash reserve ratio has also fallen. So what is the cash reserve ratio is if a bank has 10 lakh crore or 1 lakh crores worth of deposits, it has to put 6,000 crores at 6% CRR with the RBI. That is called reserve money. So bank reserves, because CRR has fallen from 6% to 4.5% now, or something like that, 4.75. 4, okay, some number, I forget the exact thing. Because of that, you've seen about, I think at least 1.5 lakh crores come out of narrow money supply. The broad money supply growth is still at 15.5%.
Okay. So means the growth is still happening.
It's still there. It's come down from the 22%. 22% is an average.
Okay.
So you had years with 28, 30%, and today you have 15%.
And who do you think that who is absorbing this money supply. So you said that banks credit, they are lowering credits to public. So who is absorbing?
Okay, one of the biggest guys who's a beneficiary of this is the government, because as a if a bank has a total amount of capital of assets or liquid or in this case liabilities, deposits and all of that stuff of 100 rupees, typically 25 rupees goes to the government
Okay.
as part of SLR, and the remaining 75% is lent out and whatever. Now that number has gone to 28%. So where private credit has fallen, the government itself has got an increased amount of money from the banks. It's one of the beneficiaries of an expanding supply.
So you mean that government is spending more and
Yeah, the government is spending, the government deficits are going to be about 5.5 lakh crores this year. It's going to spend 5.5 lakh crores more than it earns. So it's got to borrow that from the market, the banks are funding it.
Okay. Okay, thank you. That was my question.
People say by watching F2 flow, you can predict the Nifty movement. Is it true? By watching the foreign F2 FII flows, you can predict the Nifty movement. Is it true?
Okay, I haven't run this test. I have a software called Wealth Lab. I put a series of correlation attempts at trying to run a strategy with FII flows in 2009 or 2010 on the Nifty, and that I couldn't find a single trade. I mean, it was a system that said, you know, maybe 50% successful and all that. But, and plus you have this reaction time, right? You get to know about FII flows one day later. The same day data is actually revised and produced by SEBI one day later on equities. So given that you have a one day lag to buying, if you have to buy, how will you know that FIIs are buying today until it's already closed today? So would you buy tomorrow? And if you did buy tomorrow, that was not a really winning strategy. So I haven't found anything, but you know, it's been 3 years, so maybe they correlate better now. So I'd encourage you to test it. In my view, I haven't found anything that's, the best, somebody told me this. I was in Bombay. He was at a large brokerage house, and he sits next to the guy who gets the phone calls from FIIs to buy shares and sell shares. He says when that guy's phone was ringing a lot, I knew it was time to buy. Okay, because if the stock market's going up, and so the ideal is if you get that kind of news, that's fine. But if you get news like us, which is at the end of the day, I don't know how useful that is, because they'll buy one day, they'll sell the next day, and you, by the time you react, you may not have enough meat out there to make a profit. However, you can look at stocks which FIIs invest in fresh. So if an FII starts, when you get those disclosures, right, that I've got 1% of this company or 2% of this company, if an FII is a new entrant into a mid cap, that might be an indicator for you to buy. However, I've seen FIIs are largely, I'm sorry to say this, but it's a lot of our own money that has gone out and is coming back as FII money. It's not necessarily foreign investors, okay. So it's, one day if some political party wants to win an election, you'll find FII flows go higher also. So you don't know what the reasons are. So I don't really know if that's a real true indicator.
Last Friday, the market crashed. That system error, SEBI also said that they will probe, but market never reacted that highs of that day. What's the fundamental reason to fall so much?
Well, actually the reason was that MK Brokers thing, right? So he punched the wrong order and it was Nifty. It doesn't add up, but so I think the market was going to go down a little bit, but it went down a lot. So I don't think it is any more reason than that. Any good books on the Microsoft? That's quite interesting. Actually, I haven't read some of, I haven't read all the good books, to be honest, but some of the interesting books to read. There's a book called Bailout Nation by Barry Ritholtz. It's a foreign edition book. You don't get it in India so well. This is, to see the impact of interesting analysis of how traders have used macro data. There is these books by a guy called Jack Schwager called Market Wizards, the New Market Wizards, and so on. He interviews traders. So there's some traders who trade macro data and use macro data in their trading. So you can read that book. That's where I got the example of that 1991 James Baker saying the word regrettably. That's a great set of books. I would recommend reading for any trader, in fact. Market Wizards. There are two books, three, now four. Market Wizards, the New Market Wizards, then something called Stock Market Wizards. Everybody from James Baker to some guys who've traded with George Soros and D. Shaw and all of these guys have been interviewed in the book.
Excuse me.
In that also, to be honest, but this was 2009, which reminds me, I have a task. I have to go back and run that again. So see if there's any interesting moves there.
If put call ratio increases means how it will impact on the market?
Actually, that's a good question because I don't know if I knew the answer to that, I'd have been trading it. I don't think there is an impact in the market that can be determined. I think the market impacts it, but it doesn't impact the market. As in, if you try to trade using that as an indicator, you would probably lose money. That's my thought process, but everybody has a different analysis. So, I used to think that that's an interesting point. Is it extremely bullish or extremely bullish? If I said it was extremely bullish, my assumption could be two things. It's either good market is going to be bullish or the market is going to crash. But the data tells. Yeah, I mean, if you analyze it from an algo point of view, I would have to say at an extreme trade. Tell me whether to buy or sell. So if the call ratio is 1.25, which is let's say a high, or 1.4, which is a high, should I sell? Or should I? If I did a sell and then bought back when it was, at a trailing stop loss or something like that, I don't make any money. That's what my back tests tell me. But if you find better results, tell me. I think it's a new strategy to trade. Great, thank you so much. Oh, there's no. Question is, which is the best leading indicator for the market Nifty? I don't know any that are sufficiently leading to be useful enough. Actually, if I knew a sufficiently good leading indicator, my pay would have been outside. But I don't know one. I've been find one as well. I found that the stocks above the DMAs that leads most of my other moving average indicators by a little bit, because it's a broader market indicator and it gives me a more stable zone to either short from or buy from. However, it doesn't lead all the time and it doesn't give me all the opportunities. So the ride from 5,300 to 5,700, there was no indication at all. I don't think heat maps are useful for trading. Heat maps are very nice to look at. They're great. There is a reason why they look good and we like to look at them. I don't know how to trade them. Would you trade by looking at a heat map and say, I'll buy the most red stock? I've tested that, doesn't work. Would you buy the most green stock? I've tested that, doesn't work. So, but what would you do? I don't know how you would trade a heat map. So, okay, maybe I'm not so good in the mathematical aspect of it, but I don't know how to correlate, various size boxes. I think there's a good point when the whole map is red. it's telling me the market is screwed, right? A lone green spot, because it gives me a 1 point view of the market. I like that. Whereas if you showed me only graphs, it will take me time to think, oh, everybody is going down. Whereas red is good. But trading it, I think, I don't know. I don't think it's sufficiently strong enough as an indicator to trade it. But it could be useful as a supporting tool. Actually, it's an interesting point. I don't know if a heat map or its relevance can be used for trading. Since it's visual, I'm not sure how you can correlate it. So that's a point. Never thought of that. Okay, is the top 6, if the top 7 stocks are going down, is that a good supportive point of the index? I haven't that. That might be interesting. However, the problem is the way heat maps are configured. You don't know if you'll get a situation every day. You'll get a situation once in 10 days, once in 15 days. But it's an interesting strategy. I haven't tested. I'm sorry. I don't know the answer to that question. So I haven't tested anything. Thank you very much. It was great to be here.